Today we're talking to Martin Checketts from Mills Oakley Lawyers about some of the legal aspects of buying and selling a financial planning business.
One important consideration for a buyer of a financial planning business is whether they'll need to pay any stamp duty on that acquisition. And the answer for that varies from state to state. So what we need to do is understand firstly the transaction structure. Is it the sale of a business, of a client register, or the sale of shares in a company or units in a trust? And we also need to understand the geographical location of the assets of the business. And in the financial planning context, that normally means where are the clients based. So, for example, if the business is in Victoria and all of the clients are based in Victoria and there are no assets in any other state or territory, the sale of a financial planning business, or indeed the shares in a proprietary company that owns a financial planning business, will not be a dutiable transaction. There'll be no stamp duty for the buyer to pay. But that may well not be the case in other states and territories. When considering whether stamp duty is payable on a transaction, it's also important to give thought to whether the transaction is a business sale, where you're selling all of the assets of a business, including its goodwill, or simply a client register sale, because often the stamp duty treatment is different. A good example of that would be New South Wales, where if a business and its goodwill are sold, then that's a dutiable transaction and stamp duty is payable by the purchaser. Whereas if it is the mere sale of a client register with no associated sale of goodwill, then it's not a dutiable transaction. And where we sometimes see buyers go wrong is where they have a quite legitimate bona fide sale of a client register only, so it shouldn't be a dutiable transaction, but the document has been drafted in a way that will make it look, from the perspective of the New South Wales State Revenue Office, that it is indeed dutiable. Similarly, the sale agreement may include a broad and robust non-compete clause. In other words, an obligation for the seller not to compete with the buyer's business for, say, 1 or 2 years following completion. Now, that sounds all very well and good if you're the buyer, but what you have to remember is that that type of non-compete clause is often seen by the State Revenue Office as being indicative of the fact that you have purchased the goodwill, because you're then shutting the seller out of the market and you're not letting them compete with you. So if what you're doing is selling a client register and buying a client register, and if what you expect is that that won't be a dutiable transaction, it's very important to seek some good advice on that and to ensure that the way that the document is structured is consistent with that.